so today we will start with FAC 16, right? So far, what have we done so far? We are looking at the balance sheet, right? And on the balance sheet, we've looked at what? Some of the non-current assets, right? We've looked at PPE, property, plants, and equipment, how to account for PPE, how to recognize PPE, everything that we need to investment property, IS. In subsequent recognition of investment property. Then we also did what? We've also done inventory, right? We've been able. So can you see my screen?
Yes, we can see.
Yeah. Okay. Cool. So yeah. So we also tackled inventory, IS2, right? We spoke about the how to recognize inventory. What is inventory? Definition for inventory. Yeah, initial measurement of inventory, subsequent measurement of inventory. We look at the FIFO, we look at the LIFO, we look at the weighted and average. So all that we are doing is that we are taking an element of the balance sheet and we are going deeper to be able to understand how do I recognize it. And if I see a property, plants, and equipment, what is the definition? What is a property, plants, and equipment? How do I recognize it initially on the balance sheet? What is the recognition criteria for me to be of, like a story? And they will tell that for the item of property, plants, and equipment, you will not be able to do well. So under property, plants, and equipment, we did what? Initial recognition. We first started with the definition. The initial recognition, subsequent recognition, we looked at the depreciation, we looked at revaluation. When it's revalued, what happens? How do you disclose property, plants, and equipment in the notes to the financial statement? So yeah, so that's where we are. So we're taking every element and we are going deeper, for us to be able to understand it, so that whenever we get a question, we know the journal entries to part. We know how to account for it. That's what we are doing. So we are learning how to account for the elements in the financial statements. And we have started with what? The balance sheet. Good. So today we're going to learn about another one. Last week, before we left off, we did investment property. Today we're going to learn about leases. Leases. What that is what we are going. Yeah. So in the standard that
Gordon.
IFRS 16, International Financial Reporting Standard 16.
Gordon.
Yes. Yes. So we're going to, if you look at the topic, we're going to learn about the outcome of the model, the right of use of assets, lease liability, initial measurement of right of use of an asset, calculating present value, subsequent measurement, and so on and so forth. And the reason why we're doing this is that so that when we get a question, it's about a lease, we will know how to treat it in our balance sheet and our income statement. Because if you don't know, if you don't know it, you won't be able to know what to do. Cool. Right. So this is a lease. Initially, for those of you, I don't know, but initially a standard was the old standard was called IS 17. So the IS 17 was classifying lease into finance lease and operating lease, But the standard setters, they realized that that classification of classifying an asset, a lease, into finance lease and operating lease was very lease and operating lease when they feel that it will favor them, right? Or the balance, the income statement will look better, or they will decide to classify something as finance lease when they feel that it will make their income statement look better. So the setters of the standard thought about it and said, no, we have to bring a statement that actually prevents that subjectivity of people classifying something as finance lease and operating lease when it suits the company. We're not going to do that. So now they brought a new standard. That is why it's called an IFRS. It's a new standard, International Financial Reporting Standard 16. It hasn't been that long. I think it's been about 3 years or so. It's quite new, right? So that is what we are going to be talking about now. So it's before we start, we look at the definition, all right, of a lease under IFRS 16. Definition of a lease. It says that a contract is or contains a lease if it conveys the right to control the in exchange for consideration. Okay, cool. So like I said, so what is a lease under IFRS 16? It says a contract is or contains a lease if it conveys the right to control the use of an identified asset for a period of time in exchange for consideration. In exchange for a consideration. So if a contract meets this definition, then it is a lease. Then it's a lease under IFRS 16. And IFRS 16 says that if it is a lease, then you must recognize it on the balance sheet. You must recognize it on the balance sheet, right? So previously, if you classify something as operating lease, you have the liberty of not putting it on the balance sheet. But the new standard says that if there is a contract and the contract conveys the right to control the use of an identified asset for a period of time in exchange for consideration, then that contract contains a lease, and therefore it must be recognized on the balance sheet. Whether you like it or not, you must put it on your balance sheet. You must put it on your balance sheet. So that is what IFRS 16 is all about. So the right to control the use. So for example, so I've got an example here from CPD box. It says, so you have a truck, right? You have the lessor, right? In an agreement for a lease, you have the lessor, then you have the lessee, right? The lessee is the one who is what? Who is leasing the asset. The lessor is the legal owner, right? Who has transferred his asset to the lessee, right? In exchange for what? A consideration, right? So that's what a lease is. So under normal circumstances, when you don't have the money to be able to buy something, the thing is too expensive, you can decide to lease it, right? So take it from the lessor, use it, and then in turn you will pay the lessor some form of consideration for the use of that asset, and that is what is called a lease. But the standard of IFRS 16 states that if it conveys the right to control the use of an identified asset for a period of time in exchange for consideration, then it's a lease. So look, so watch the item that I'm bold, the right to control. Then what? Identified asset. So when there's a contract and the contract has the right, the lessee has received a right to control the use of an asset, but the item cannot be identified, right? It is very ambiguous. We don't know which asset it is. Then it is not a lease. Under IFRS 16, it is not a lease. And then also there has to be an exchange for a consideration. An exchange for a consideration. Good. So if you look at the picture, the lessor is here, the lessee is here. The lease asset is the truck. The lessee pays the lessor some, amount of money, maybe yearly or monthly, for the use of the asset. Does everyone understand what a lease is? Any question on this? Maybe someone does not understand what a lease is. Does everyone understand what a lease is?
Yes, we understand.
Good. So IFRS 16, you should be careful about these things. Can the asset be identified? From the definition, it says what? A lease is a lease if it conveys the right to control the use of an identified asset. So in the contract, there has to be a certain asset that has been identified. If the contract doesn't state that, then it is not a lease. Can the asset be identified? Example, is it physically distinct? Number two, can the customer decide about the asset use? Remember, it also states in the definition that what is a conveys the right of use, the right to control the use. So that means the customer or the lessee has to be able to decide how to use the asset, right? Because he's got what? The right to control the use. Good. Can the customer get the economic benefit from the use of the asset? Can the lessee get the economic benefits? So basically, if he controls the use of the asset, then it can be inferred that he also has the economic benefit for the use of that asset as well. Can the supplier substitute the asset during the period of use? So in this case, it is saying that does the supplier or does the lessor have that option to substitute the asset? You know? Yeah. So if the answer, we are going to now analyze these things in a question, because UNISA will give you a question, will give you a scenario, or give you a passage, like a paragraph, and says that, is this a lease? And you need to be able to what? To talk about all these things, talk about the definition, and be able to apply the definition to the scenario, and you conclude. Like I always tell you, whenever you are asked a theory question, state the definition, apply to the scenario, state the recognition criteria, apply to the scenario, and then conclude. That is how you get maximum marks in a theory question. Definition, you state the definition, then you apply it to the scenario. Then you state the recognition criteria, then you apply it to the scenario. Then you conclude. Okay. All right, accounting for leases by lessees, right? Lessees do not classify the lease as finance operating. So right now in this new standard, so right now the standard of IAS 17, the old standard has fallen away. We no longer use the old standard again. It's the new standard, which is called what? The FAC 16. That is the main standard for leases. So every lease question that you get going forward from now on, it is from FAC 16, IFRS 16. Okay. Cool. Initial recognition. At lease commencement, a lessee accounts for 2 elements. Okay, so right now I did say that. Now the standard says that when you have a lease or the contract complies with the definition of a lease, then you must what? Capitalize the asset. Or in other words, you must put the asset on your balance sheet. And if you are to put your asset on the balance sheet, then it means that what? There's a general entry that must affect your balance sheet, isn't it? Good. So when you initially recognize a lease, right? Is a lease an asset or a liability? What is a lease? Is it an expense? Is it an asset? Is it a liability? And why? Or is it equity? Or is it income? What is a lease?
It's a liability.
It's a liability. Why? Your why is what is important to me. Remember, we are accounting for it from the lessee's point of view. The lessee's point of view. Okay? You said it's a liability. Why?
Because the lessee is obligated, once the contract has been signed, he or she is obligated to make payments or transfer payment for a period of time. So it becomes a liability.
Good. I like that. I like that. Any other person to add?
I like that.
I like to add, it's also an asset.
Okay. Why?
Because you also gain a profit while using the liability.
Good. Good. I like that. So when you are accounting for a lease, there is an asset part and there is a liability part as well. The liability part is the fact that what the lessee has to be paying regular payment, and we all know that the definition of liability says that It's a result of a past event from which future economic benefit will flow out of the company. So the mere fact that I'm paying some money to a lessor means that what there's a liability there. I have an obligation, I have a present obligation to be paying regular payments to the lessor. At the same time, the definition also says what is the right of use of the right to control an asset. And what is the definition of an asset? A resource controlled by an entity as a result of a past event and from which future economic benefit will flow. So it complies with the definition of an asset and also complies with the definition of a liability. So when you have a lease, you must recognize an asset and a liability. So you debit an asset and you credit a liability. So an asset is what? The fact that what? You have the right to control the use of an asset, which will end up bringing you what? Economic benefit. And the liability part is what? The fact that you have to render regular payments to the lessor. So that asset that you recognize is what is called the right of use of an asset. Just to differentiate it between other assets of the company. So accountants use right of use of asset to denote that this is what is a lease. It's a lease. So the asset that you recognize is called right of use of an asset. So whenever there's a lease, you debit the right of use of an asset and you credit a lease liability. Good. So because you have debited an asset and credited a liability as your initial recognition, what do you think will be some of the subsequent recognition that you have to recognize? You have recognized an asset, you have recognized a liability. That's initial measurement or initial recognition. Subsequently, how will you account for this particular item?
Rental expense.
Rental expense. Okay. Rental expense. Okay. All right. Okay. Rental expense. Good. Rental expense. Good. Any other? Remember what we said about subsequent measurement. We said that when you have recognized something initially, right, as an asset or a liability or income or expense or equity, that is initial recognition when you first bring it into the balance sheet, right? Like in this case, the first entry is debit asset, credit liability. But subsequently, you don't leave the asset or liability there. You need to account for it. So for example, for an asset, we depreciate it, right? That is the subsequent recognition. We also do what? We can also impair it, right? Impairment. We can revalue it. We can fair value it. We can even, for an asset, we can also sorry?
Sell it.
We can.
You can even sell it.
We can even sell it. Yes, you can even sell it. Yeah. So when we sell it, what is when we maintain it, maintenance, what is going to happen? Yeah. So that's what subsequent recognition is. So that's for an asset. And for liability, when we have accounted for a liability, what is the subsequent measurement? A liability. If I recognize a liability, what is someone has mentioned one to say the rental expense. What other subsequent thing?
Finance cost.
Finance cost. Good. Whenever you have recognized a liability, there has to be finance cost, because it's like going for a loan from the bank. Every month or every year, you need to accrue for the interest on the loan, isn't it? So the liability is a loan. Every month, every year, you need to account for the interest on that liability. So you look at a liability is a loan. So if you have recognized a liability, that means that every month or every year, depending on the contract, you must account for it. For the interest, you must account for the interest. Good. Guys, that's brilliant. Yeah. So the right of use of an asset is the asset part and the liability is the liability part. Good. The journal entries for FAC 16, right? So you debit right of use of an asset, and you credit the lease liability. Now, what we are going to learn now is that how do we obtain the value of the lease liability, and how do we obtain the value of the right of use of asset? So now we know that a lease affects both it affects both an asset and a liability. The journal entry is debit asset and credit a liability. Now, how do we obtain the value for the right of use of for the asset part, and how do we obtain the value for the lease liability, the liability part? Good. Okay. So the standard also says, guys, remember that I always say that this is a lecture, right? When you come to this workshop, this workshop, we cannot do every single thing. So, but what I tend to do is that I will go through the principles so that you understand it. Once you understand the principles, taking the book and reading through it becomes so much easier, because now you understand why we're doing it. You understand the principles. You can make sense of it, because now what we apply to real life scenarios. And what I also do is I also take out the difficult aspects, the one that I think that you may struggle with. That is what I highlight in class. So from here, I expect you to go back and go to your child letter and go through FAC16 to understand, to have a comprehensive knowledge or understanding. Good. So here it says that the right of use of an asset, initially the right of use of an asset is measured in the amount of the lease liability, initial direct cost. Then it's adjusted by the lease payment made before or on commencement date, lease incentive receives, and any estimates of dismantling cost and restoration cost. Hey, that is a mouthful. It's a lot. Let me break it down. What the textbook is saying, or what your TAT letter is saying, is that when you have to, the way you recognize the right of use of an asset is that you first have to calculate the liability part of the lease. That is the starting point of your assets. So when you want to recognize the right of use of an asset, you first have to calculate first what? The lease liability first. Then after you've calculated the lease liability, then you add the initial direct cost. So direct cost, like direct cost of the lease, like maybe you paid some legal fees to a lawyer, or you added some aspect of the you mounted maybe some platform you mounted the asset on a platform, or other direct costs, basically. So it says that the right of use of an asset is measured in the amount of the lease liability plus initial direct cost. So if your starting point of the asset is what? The liability. So you first have to go and calculate the lease liability first. Then you add other direct costs like lawyers' fees, conveyors fees, legal fees, and so on and so forth. You subtract lease incentives, right? Incentives are the thing that the lessor gives onto you. It's like a rebate, right? You subtract a rebate from it. Where have we seen something like this? When we are accounting for property, plants, and equipment, we also said what is there? All the costs incurred to bring the asset to its current and its current condition or location, but excluding what? Rebates. The same thing applies here. Excludes rebates, but you need to include initial direct cost, and also what? Any estimate of the dismantling and restoration costs. Where did we find that? We saw that in property, plants, and equipment. We also saw that in investment property, right? That when you have an asset and you are, after 30 years, you have to restore the asset back to, or restore the site back to its former glory. That cost that you are going to incur to restore the site, it has to be included in the cost of the asset initially. So you have to estimate it. So let's say you are standing today and you are going to restore the site in 30 years' time. You need to be able to to estimate how much it's going to cost you today for that cost you are going to incur in 30 years time. And what do? You use what? The present value to discount it using what? The imputed rate, or the rate that the lady mentioned. That's the first time that she actually saw that rate. By the imputed rates or by the implied rates, that is what you use to do that. So that is how you calculate the right of use. So the right of use of an asset is what? It's first the lease liability plus initial direct cost plus a provision for dismantling cost in the future. You bring it back to the present value. I'll show you how to do that. And then less what? The rebates or lease incentives. Then let's look at how do you account for the lease liability. The way you account for the lease liabilities is that you look at all the payments you are going to be making for this lease. So if this lease is for 5 years, estimate all the payments you are going to be making for the next 5 years and bring it back to the present value. Using what? An implied rate or an imputed rate. I think last week we did an exercise that if you have been given the present value and you have been given an interest rate and you have been given a certain payment, it's easy for you to calculate what? The present value. What do? You plug it in your financial calculator. You say N equals 5. That's the number of years of the lease. I, for example, maybe it's 12 years equals 12. Payment is maybe 600,000. Compute present value. It will give you the present value of that payment you are going to be making, right? It's like that. I'll show you how to do it. So that's how you calculate the lease. This particular way of present value, you are going to see it for the rest of your life. If you go to the bank and you are going to borrow money for your mortgage, they tell you, okay, I want my mortgage is 20 years. The interest rate is prime. I don't even know what prime is. And then you say you are going to be making payment, whatever. This is the same thing that they use. The bank uses to tell you how much payment you should be making on a monthly basis for you to be able to pay your mortgage bond in the 20 years. It's the same thing. So this calculation, you see it in management accounting, you see it in financial accounting, you see it in finance, you see it in investment, you see it everywhere. It's called a present value calculation. You see it everywhere. Okay. Any questions so far? Any questions so far? Does everyone understand? Yes.
Yes, sir. So is it possible? So last night we did our assessment and stuff, but there's also, this will be covered in assessment 3 and going forward. Is it possible for you to give us like formulas, like how you said now, right? How you calculate right of use of assets, even lease, like in every step, or probably. Well, just like, please.
Okay, all right.
And then also just if you could show us how to actually calculate the present value and future values step by step.
All right.
Thank you.
Cool. Thank you. All right. Any other question? Okay, cool. So now we know the definition of a lease. We know that a lease, whenever there's a lease, there's an asset part and there's a liability part. We know how to get the value of the asset part and how to get the value of the liability part. Just that we haven't done it. We are not going to do examples, but at least that's what I want you to get so far. Good. The journal entries, right? Debit, right of use of an asset. Credit and lease liability. Good, because I have debited an asset, because I have recognized an asset and I've recognized a liability. There is what? The subsequent measurements. Because if I have an asset, that means I must depreciate it, right? I may also have to maybe revalue it. I may have to impair it. Impairment is, you haven't done that, you do it later, not at this level. But impairment is when you feel that the asset value in your balance sheet is is lower than what it is, you know, then you have to impair it, to bring it down to what the market value is. That's what the impairment is. But don't worry about it. You do it later. Because I've recognized a lease liability. If I have a lease liability, it means what? I have a loan. If I have a loan, how do I treat a loan going forward? I treat a loan by recognizing what? The interest on the loan. Good. So here we are talking about the asset, right? We said that the lessee pays legal fees for, sorry, I made a mistake there. It should be the lessee pays legal fees for negotiating the contract. So this is some of what, this is what? An initial direct cost. Initial direct cost. What did we say about initial, what did we say about initial direct cost? It must be added to the asset. So how do you add it to the asset? You say debit right of use of an asset, credit the supplier. Either it could be a bank or a lawyer or so on and so forth. So you debit the right of use of an asset and you credit bank. Or if it's accounts payable, you say debit right of use of an asset, credit accounts payable, or credit legal fees payable. Does everyone understand? When I've done that, what have I done? I've added the legal fees to the asset because I've debited right of use for an asset and I've credited bank. I've increased the value of the right of use of an asset. Does everyone understand this? I'll repeat. I say when you have initially recognized the asset, right, of a lease, the asset is, so you've done the asset, but then if there's any initial direct cost like legal fees, whatever, it needs to be added to the asset. What is the general entry for that? You debit right of use of an asset and you credit bank, or you credit legal fees payable. And then I also say that for the asset, you must also include in the asset what? Estimated cost of restoring the site, right? After 30 years or 50 years or whatever it is. What is the general entry? I debit the asset and I credit provision for asset removal or provision for restoration of sites. You see, all these general entry and power, what am I doing? I'm increasing the value of the asset because according to the standard, you must, the asset includes the asset, the cost of the asset is which you get from the liability, plus any initial direct cost, plus any restoration cost, minus any rebates. So if there's going to be a rebate, what would the general entry be? If there's a rebate, the general entry would be credit the asset and debit what? The rebate. Oh, okay, yeah. Cool. So there is some schematic representation here. Is there an identified asset? You said yes. That's according to the definition. Is there an identified asset? You said yes. Good. Does the lessee or the customer have the right to obtain the substantially or the economic benefit from the use of the assets? You said yes. Good. Does the lessee or the supplier or neither party have the right to direct how and for what purposes the asset is used through the period of use? Yeah, if the customer has it, then the contract contains a lease. If the supplier has it, then it is not a lease, right? Good, because the customer, the lessee, must have the ability to be able to direct how the asset is going to be used. If the lessor or the supplier is the one directing you on how it is going to be used, then it means that you don't have control. The lessee doesn't have control. And therefore, if the lessee doesn't have control, then it does not comply to the definition of a lease. Why? Because the definition of a lease says that the lessee must have the right to control the use of the assets, not the lessor or not the supplier. Cool. Yeah. And then does the customer design the asset in a way that predetermines how and for what purpose the asset will be used throughout the period of use? If it's yes, yes, it is a lease. If it's no, It is not a lease. So this schematic diagram presentation can also be able to enhance your understanding of the definition of a lease. Okay. Any question before we do an example, so that you'll be able to understand it better? Any questions so far? I'm giving you 1 minute. Just read this question and digest it. Okay, cool. Let's do this question together. Sunshine Limited, the lessee, entered into a contract with Energex Limited, who is the lessor, to rent property space of 20 meters square of Energex Limited's 100-meter property, right? So the lessee is just going to rent a property space, just like 20% of the lessor's property, to sell its solar panel for a period of 3 years. Energex, who is the lessor, has the right to change the location allocated to Sunshine Limited at any time during the period of use. There are minimal costs to Energex Limited associated with changing the space used by Sunshine Limited. Sunshine Limited makes use of a mobile truck, which it owns, to sell solar panels that can be easily moved. Sunshine Limited will pay Energex Limited $8,500 per month to make use of the property space. Now the question is this a lease? This is exactly how UNISA will ask you. Discuss, is this a lease? Okay, FAC 16. What do you think?
Yes, it's a lease.
Yes, the answer is yes.
Why?
I will say it's not a lease because the reason I say it's not a lease is because it doesn't meet all the definition of a lease. Yes,
Okay.
there is a contract, but there's one that is missing where Sunshine they don't have right of use because Energex is the one who's having all the control.
Okay. Okay. And okay, good. I like that. Any other person? Remember with accounting, so this sort of theory question is about how you can argue your way out, eh? If you can argue it to convince the examiner, you will get it. Because it's all about the examination technique is that what? You state the definition, you apply it to the scenario, and you conclude. Anyone who thinks so, she thinks it's not a lease. Anyone who thinks so, anyone who thinks it's a lease, and why?
I said it's a lease.
Why?
In this case, Sunshine is leasing a portion of their of the property they own.
Yeah.
Meaning they transferring like 20% of the right to control to
To Sunshine.
To Sunshine. Yeah, I wanted to say to Sunshine. And then there is also they meet the contract will have a period of time which is 3 years in this case.
Yeah.
And there is also an exchange for consideration.
Good.
Which is 8,500 rand per month for that period of 5 years. I mean,
Good.
3 years.
Yeah. Yeah. Good stuff, guys. Good stuff. So yeah. So and I like the way you have done it. So when you have a theory question, guys, don't just say, oh, it's a lease because no. You first do what? You state the definition. Then every part of the definition you apply it to the scenario. And I like the way the one who just spoke that did it. So even if you ended up getting it wrong, you will get marks for everything you have stated. Because remember, some part may comply with the definition and some part may not comply with the definition. When we are marking, you need to tell us. So there will be part that you are right. Yes, it complied. There will be part that is right. And every whatever you say, we will mark. So even though maybe the conclusion might not be right, but because you have stated and you have applied it to the scenario, you will get what? 80%. You get like 8/10. So you are not going to get 0. Because you've done what? The good examination technique. Applying, you've stated the definition and you've applied the scenario to the definition. And you mustn't stop. So let's say you start with saying it's control, and then it complies with control, but then you get to a part where you say it has the right, and then it doesn't have the right, then you stop there. No, you need to carry on and finish the whole definition, applying the scenario to the definition to the end. So it's only at your conclusion that you state that, okay, so even though it applies, I mean, it applies to some, or the scenario applies to some part of the definition, but it doesn't, because it doesn't comply with this other aspect. Therefore, it is a lease or it is not a lease. That is how you get maximum marks in a theory question. So you state, you apply, you state, you apply, you state, you apply, you conclude. That's how it works. Good. So in this question, it says that as per FAC16 lease, the contract contains a lease when the contract conveys the following. So you see what they've done. So they've stated the definition. It contains what? The right to control the use of an identified asset for a period of time in exchange for consideration. So you must talk about period of time, just like the lady did. You must talk about in exchange for consideration, the 8,500. You must talk about everything, and then you conclude and say whether it is or it's not, right? Good. So you don't stop. When you realize that some part does not comply, you don't stop, you carry on. Good. Discussion of the lease definition. So right to control the use of an identified asset. As per FAC16 lease, a contract conveys the right to control the use of an identified asset when the customer or the lessee has both of the following: the right to obtain substantial or economic benefit and the right to direct the use of the identified asset. The contract specifies the amount of property space the Sunshine Limited is entitled to use. However, the property space is not fixed, and as a result, there is no identified asset. Remember that one of the aspects of the definition is what? There should be it should be what? It's a contract contains at least when the contract conveys the following: the right to control the use of an identified asset. So the asset has to be what? Identified. There has to be a specific. Basically, it says that when you read the standard, it says a specific asset. So not in this case where they can change the location whenever it suits them. Today is 20 meters to 20 meters square. Tomorrow I give you 10 meters square. The next day I give you 40 meters square. No, it has to be what? A specific asset. So if in this question, if it had just stated that I'm just going to give you 20 meters square, and that is it. But now if there's an instance where the lessor is now coming now, which is changing the location from 20 meters square to 10 meters square to 30 meters square, then it is not a specific asset. That's one aspect. So it doesn't comply with that identifiers. Then even though Sunshine Limited control its own mobile truck, the contract is for property space on the. Okay, so it just wanted to talk about the truck, which I'm sure some people may talk about, some people may leave it out. It's fine. Then Sunshine Limited does not have substantial all the economic benefits from the property space. And why? Because NHS Limited could benefit economically from substituting the property space as there are minimum costs. Remember, it also mentioned in the paragraph that the cost of shifting the location is at a very minimal cost. That means NHS can do it at will, because there's no cost implication. So they can decide to shift the locations at no cost, which implies that they are more susceptible to be what? To shift it, because there's minimal cost to shift that. So NHS could benefit economically from substituting the property space as there's a minimum cost involved in moving the mobile truck. NHS Limited benefit from substituting the property space at its own property for something else that could be more effective. NHS Limited has the right and practical ability to change the property space used by Sunshine Limited anytime during the entire period, thereby directing the use. So like you see, because now NHS can be able to shift the location at any point in time, it looks like what? They are directing the use. They are directing the use. And therefore, it is not a lease. So for a period of time, and look at what they did. So for a period of time aspect, they stated period of time. The contract is for 3 years. That alone is 2 marks. It's 2 marks. In exchange for consideration, Sunshine Limited will pay NHS Limited an amount of 8,500 Rand per month. That is also what 2 marks. So even though some other aspect, other part of the definition didn't comply, but some aspect you need to state it, and then if it you need to state it and tell us, then you get your mark. Then conclusion: there is no identified asset, and Sunshine Limited does not have the right to control an identified asset, and therefore all the conditions have not been met, and as a result, the contract does not contain a lease. So it's very easy. Or it's about what? Putting the definition down and applying it to the scenario. That is it. Any questions?
Mr. Gordon?
Yes.
I was failing with my mic. I have an issue with this part, the last part that says direct the use of the asset. Shouldn't that still remain with the lessor? Because if, for instance, we want to enter into a contract and it's a residential area, I'm leasing this room to you.
Yeah.
And then tomorrow you signed a contract with me, you're paying me, and then tomorrow I find you selling stuff from that room because you've got the power to direct the use of that.
Okay.
Does that lease still hold, or can I revoke that lease saying you breached the contract even though you were allowed to direct the lease?
Okay, I think just come again. So you said what? You're giving me an example of a situation whereby what you rent a property space to somebody, right? So you are the lessor, and then you rent it to a lessee, right? And then what? You, the lessor, start selling items from the property. Is that what you're saying?
Yes. Please go back to before the solution. The last part here. Oh, no.
Is
Before
it here?
the solution, no, let's move forward. Yeah,
Forward.
the last part here
Okay.
says thereby directing the use. Should the directing of the use remain with the lessor or the lessee?
Direction of the use should remain with, if you want to be a lease, it should remain with the lessee. Energy Limited has the right and practical ability to change the property space used by Sunshine Limited anytime during the entire period, thereby directing the use. So the direction of the, remember, the whole thing boils down to what? You are directing the use for what? For benefit. Who must get the benefit? The lessee must what? Get the benefits. If the lessee is not getting the benefit and is the lessor getting the benefit, then it's not a lease. I'm directing the use. I'm directing the use because I want to be able to obtain benefit. I want to be able to restrict other people from benefiting from it. And if I'm not able to restrict other people from benefit from it, and the lessor can also benefit from it, then I don't have the right of control, right? And which means that it doesn't comply with the definition.
Okay, no, I understand it now.
Yeah, so the control part means that I must be able to restrict other people. I must direct it for my own benefit and not anybody else. If someone else is benefiting, then I don't, my control is shady there. Okay. Cool. Recognition and measurement. Remember, for any balance sheet item, we need to know how to recognize it and how to measure it, right? We've talked about initial recognition, right? When it meets the definition, in this case, in this particular standard, it doesn't have any recognition criteria. The recognition criteria is inside the definition, right? So there's no, it doesn't talk about recognition criteria, because the recognition criteria is in the definition. It talks about what? The regular payment. That means I'll be able to measure it reliably, and also what? It has there's a probability that what? There is the probability the economic benefits will also flow. Yeah. So the probability is inside there. Right. So we know though. So once that is done, we can recognize the asset. Now, once we recognize the asset at what amount? So that's what it's talking about. What measurement? We know now it has made a definition. We can recognize it. Now, at what amount? That's what measurement is about. So that's where we have what initial measurement. and then we have what? Subsequent measurement. The initial measurement is what? At what amount must I recognize initially in the balance sheet? Subsequent measurement means that now I've recognized on the balance sheet subsequently. How do I now account for it? An asset, I know they have to depreciate it. A liability, I know I need to account for the interest, right? Those are the subsequent measurement. Good. So for this reason, the lessee is required to recognize both what? An asset and liability. I think we've spoken about that already. Recognition exempt. Okay, so the standard of IFRS 16 also says that there are two situations where you can be exempted from what? From applying IFRS 16. One, if the lease is 12 months or less. If the lease is 12 months, you can opt. It doesn't mean that you don't have to recognize, but you can decide that you don't want to apply or you don't want to comply with IFRS 16, and therefore you don't need to recognize it on the balance sheet. When you recognize something on the balance sheet, what is the effect? Why would an accountant not want to recognize something on the balance sheet? What do you think? Why were accountants not happy about this standard? Why would they not want to recognize something on the balance sheet, especially for a lease?
Because we need to consider the financial years.
We need to consider the financial years. What do you mean? Can you go a bit deeper?
So if it happened for 3 months or a month or a week, okay, I don't know how to
explain it. Okay.
Yeah, to express myself properly.
Yeah. So I'm an accountant, and now I get this standard, and this standard is telling me that if the lease meets the definition of IFRS 16, or if the contract meets the definition of IFRS 16, then I must put it on my balance sheet. Do you think every accountant or every company is happy to put things on the balance sheet? No.
I suppose.
Oh, okay. Okay. All right. Please speak.
I was gonna say, I suppose because on the balance sheet you have to show your liabilities and your assets.
Good.
If you show it there, then you're gonna increase your liabilities, which then shows that you're not really making much in terms of your net at the ball. Yeah.
Exactly, sure. So if you have to recognize some, in this case, this lease statement says that I must recognize an asset and a liability. When I recognize, I mean, which company wants to recognize liabilities? Liabilities looks bad on your balance sheet, right? Because when you go to the bank looks at all your liabilities. Guys, not your liability is too much. Your credit profile is too much. You have too much loan. I can't give you extra loan. So that can be something that is not good. The asset part, they may like it. They may, doesn't mean they will. They may like it because an asset increases your total asset. The total asset looks good on your balance sheet, but the liability aspect, that is a bit some way. And also what happened was that accountants wanted to expense the lease payment in a form of rent, right? So they wanted to take it to the income statement. What happens when they take something to the income statement? They get a tax deduction, right? So they wanted this lease, they wanted to account for it in the income statement, not on the balance sheet. Because balance sheet means that now I need to depreciate, and depreciation over a certain time. So I'll get the deduction only. I'll get it. In fact, even the way the receiver of revenue works is that the receiver of revenue, so I'm diverting a bit, but it's important for your understanding. The receiver of revenue does not recognize this lease, actually. The receiver of revenue recognizes only the lease, the rental expense, while the accountant recognizes the depreciation. So there's what is called a deferred tax. We'll get there. So the receiver of revenue doesn't care about IFRS 16 the way you are accounting for it. The receiver of revenue say, guys, this is a lease. So from a tax point of view, they say, guys, this is a lease. I don't care what you treat it, whether it is treated according to IFRS 16 or whatever. The fact that you are paying rental income, I'm going to give you a tax deduction. but the standard says that what you must treat it. So you see that in accounting there are many instances where the way an accountant treats something is different from the way the receiver of revenue treats it, and that difference in treatment is what brings about what is called a deferred tax. What is called deferred tax. The receiver of revenue will say it's this. The accountants will say no, we'll treat it this way, and then it brings about some permanent or temporary differences. But we'll discuss those ones maybe on a higher level. Yeah. So when you recognize something on the balance sheet, it takes a long time for you to get your tax deduction, or VAT. You may not even get it, but they wanted to expense it. Companies wanted to expense the lease so that they will get a tax deduction. So the fact that the standard came and said that, guys, you must recognize it on the balance sheet, not many companies are happy. So there was an exemption to say that, guys, if the lease is shorter than 12 months, then you can decide not to treat it according to FAC 16, and therefore you can expense it. And also, if the lease is a lease, so you see that a short-term lease which is less than 12 months, or the lease for which the underlying asset is a low value. So if the lease the value is low, you can also decide that you don't want to treat it according to FAC 16. A low value asset, according to the interpretation note, they were saying something less than $5,000. But of course, I mean, $5,000 here in South Africa is quite a big amount of money. So the standard left that aspect for countries to decide, or for companies to decide what is a low value item and what is not a low value item. Yeah. Good. Any questions? So these are the exemptions, right? So when you have a short-term lease, or a lease that the underlying asset is a low value, then you don't have to account for it under FAC 16. Okay. The right of use of an asset. So now they are looking at what? The asset part and the liability part to say what is the difference. Remember I said, for you to be able to know what the asset part is, you first must Go and calculate the liability part. So the asset part, the liability part is the first, is your first component. Then you add other things to it, like what? Your legal fees, your restoration costs, and so on and so forth. Right. Good. So let's look at what they say. Right of use of an asset. At the commencement date, the lessee will recognize the right of use of an asset. Okay. The cost of an asset comprises what? The amount at which the lease liability is initially measured. So the right of use of an asset is start off by what? By the liability amount first. Then you include what? Any lease payment made at or before the commencement date, excluding lease incentive or rebates. Then what? Any initial direct costs. So all these are what? Plus, you add them. Or an estimate of the cost of restoration. So these are the things that will add or will increase your asset part. First is what? Is the liability, which we are going to learn how to calculate it. Then other payment, then initial direct cost, then the estimate of your restoration site cost. Then when we move to the right side, the liability part, it talks about what? How do you calculate the liability? It's what? Is the fixed payments, includes in substance fixed payments less lease incentives, which include variable leases, amount payable in terms of residual value. So when you are okay, we'll have an example. Okay, cool. Let's have an example. So that you understand how to calculate. Good. So let's see. So I have, I'm going to have a lease, right? So year one, year 2, year 3, year 4, year 5. So let's say you are going to have a lease, right? The lease is for what? A 5-year period. Year 1, I'm going to pay 60,000. Year 2, I'm going to pay 40,000. Year 3, I'm going to pay 70,000. Remember, these are estimates, right? Because these are things, they are years in the future. So you are estimating how much you are going to be to pay. Of course, you can also look at what the lease the agreement. An agreement for a lease can also say, okay, in 2024 pay 70,000, 2025 pay 60,000, 2026 pay 10,000, So the lease agreement can also what tell you how much you should pay. You should be paying for every year. Year 4, maybe you pay 35,000. Year 10, you pay 10,000. But year 5, but at the final year, the lessor will also tell you that you must pay some residual amount or some bulk payment. Sometimes like that, right? Let's say you've gone for a car and then you have a balloon payment at the end of the 5 years. So that payment, so at the end of the 5 years, instead of paying 10,000, you actually end up paying what? 120,000, because you have a balloon payment, just for argument's sake, right? So that's what the standard is talking about. What about the residual value? Talk about residual value. Good. So this is it, right? Your interest rate. UNISA will give you what the interest rate is. So your interest rate, your implied interest rate is, let's say, is 10% per annum. 10% per annum. Therefore, calculate your present value. Why do you have to calculate the present value? Because remember, you are standing here at what's today's date? Today is the 12th of September 2024, right? You want to find out what the value of your asset is at today. That's why we calculate what present. So present value means what? The value today, presently, currently, presently. That's why it's called a present value. FV, so that's PV. PV is present value. Your FV is your future value. Future value. Good. So in this case, you have that. So what you do is that you clear your memories, right? Cool. And I'll get it, because every calculator is actually different. Whether you're using a Casio or a Sharp, you just need to go to the manual, right? But you say cash flow. You say 60,000. 60,000. You press cash flow. Then you go 40,000. You press cash flow. 70,000. You press cash flow. 35,000. Doing everything. 35,000. You press cash flow. And then 120,000. Press cash flow. Sometimes this cash is not all the time that they're going to be positive, right? No. Don't worry about that. In our scenario, it is positive. Right? You assume that you're always going to have what? A positive cash flow. It's fine. Then you say your 10%, you press your I for interest, right? Then you compute NPV. I think it's NPV. You compute NPV, or is it PV? You can compute PV. You compute PV. The time you compute NPV is when you have negative and positive values. Compute PV. You should get the present value. So this is a scenario when you have irregular payments. In this case, 60 and 40 and 70 and 35 and 120. These are irregular payment, or the payments are not all the same, right? Then you have your interest 10, you press I, and then you say compute present value to give you what your present value is. But in instance whereby I tell you that your n, or the number of period is, let's say, is 5 years, right? So you are going to you have a 5-year loan, right? So this is your n. Your n is 5. Then you have your interest rate. Is 10%. Then you have your future value is, let's say, 10,000. Now calculate your present value. Calculate your present value. Where's my question mark? Yeah. So in that case, you don't use the cash flow mode. You clear your memories and you say n. You say 5 is n. 10 is I. Future value is 10,000. Therefore, what is my present value? You compute present value to give you what your present value is. Why? Because in this case, what is happening is that, see, if we draw a timeline like this, right? You are standing here today, present value, right? And you have your future value being 10,000. Your I equals 10, right? So you have instance whereby what? You have your interest rate is 10. The amount, so this is an example of the one that you are going to be restoring the site after some time. Let's say you've got an asset. The asset is a big asset. It has, when you were mounting it, or as a result of you using the asset, is going to destroy the environment. And the municipal law in that area is that after the 5-year period, you must restore the site to its former glory. Right? So in that case, what do you have? You estimate the amount is going to cost you in 5 years' time to restore it. So you say it's what? Let's say it's 10,000. You use an imputed interest rate, let's say 10%, right? Then you calculate you say compute PV to give you your present value. How much that 10,000 will cost you today? It may be like what? Maybe 7,500. 7,500. Why do we do that? Because of inflation. So because of inflation, in 5 years' time, 10,000 is equivalent is equivalent to what? To about 7,500 today, isn't it? 100,000 in 5 years' time may be just about 60,000 rand today. You understand? So in order to account for the inflation, right, we discount it, and that's how we discount it using what? An interest rate. You understand? Because in 5 years' time, something that is worth, like, let's say today is what? You buy a shoe for 1,000 rand. In 5 years' time, a shoe that you are buying for 1,000 rand is going to cost you about 5,000 or 10,000 in 5 years' time. Why? Because of inflation. So for you to be able to account for inflation, this is how you calculate it, and that's what is called what? The present value calculation. Because of the time value of money. Because of the time value of money, you need to do what? A present value calculation to say, okay, I'm going to be paying 10,000 rand in 5 years' time. What is that amount today? Today, what is that? So basically, and if you want it mathematically, right, it will be what? 10,000 divided by 10%, which is 0.1. raised to the power 5, which will give you what? The present value. Mathematically, that is, if you are not using a calculator, that is how you do it. 10,000 divided by 10%, which is 0.1, raised to the power 5, you get the present value. The financial calculator does it very quick, because all you need to do is that you input n equals 5, I equals 10, future value is 10,000, compute PV to give you your present value. But if you want to calculate it mathematically, it's like this. Okay, but in instance where you have when you have these things, like every year 1 is this, year 2 is that, then you use your cash flow mode. You say 60,000 cash flows, 40,000 cash flow, 70,000 cash flow, 35,000 cash flow, 120,000 cash flow. 10 is my I compute present value. It will give you your present value. Does everyone understand? Because of the time value of money, we need to discount future cost to the present time using what? A discounted cash flow model. This is what is called a discounted cash flow model. For those of you who will be in mergers and acquisitions and those things, or to work in a bank, in investment banking, mergers, acquisition, then this will be your work every day. You're always discounting. Okay, does everyone understand this? Can we move on? Any questions? Just read, depending on what calculator you have, just read the manual, or maybe Google. Say you have a sharp calculator. How do I calculate the present value? Google will show you, because every calculator is slightly different. The principle is the same, but slightly different in terms of the mechanics. Okay. Does everyone understand? Any questions? Okay, any questions? No questions. Good. So we know for you to get the right of use of an asset, you first calculate what? The liability component. So liability is the starting point of your right of use of an asset. Good. So I think we've done this. Normally, a lessee needs to measure the right of use of an asset using the cost model under IAS 60 property, plants and equipment. It basically means to depreciate the asset over the lease. So if now that you have recognized an asset, then that means don't forget, once you recognize an asset, subsequently you have to depreciate it. So just like you are depreciating an asset for like a PPE, to give you the useful life of the asset, maybe it's over 10 years, you divide by 10, that you get your depreciation. How do you recognize depreciation? Debit depreciation, charge credit, accumulated depreciation. Easy peasy. We've done this. However, the lessee can also apply IAS 40 investment property if the right of use of an asset is an investment property and fair value model is applied. Remember, for investment property, you can what? You have two subsequent measures. Initially, you measure investment property at cost, but subsequently you can have what? Fair value. Subsequently, it is fair value or at cost. If it's at cost, you depreciate the asset, but if it's at fair value, you don't depreciate. And we said the reason why fair value we don't depreciate is that the name fair value means that at any point in time, the value is fair. So the value does not depreciate. An example is a share that is traded in the Johannesburg Stock Exchange. At any point in time, the value you see there, the share price is at a fair value. You can't depreciate something like that. It does not depreciate. Because at any point in time, the value is the right value, which has been put there by what? By willing buyers and willing sellers. Right. Good. Does everyone understand? Any questions? So subsequent measurement, right of use of an asset. Because you have recognized debit asset, you have to what? Depreciate the asset over its useful life. Liability, because you have also recognized a liability, credit liability, you must what? Account for the interest expense. How do you account for an interest? You have a liability of maybe 13 million, you have recognized. They'll give you an interest rate of 10%. So at end every year, what? It should be what? 10% times 13 million or whatever. Then you get the interest. What is the journal entry for interest expense? Debit interest expense, credit what? Interest liability. So you will see that your liability, as you are recognizing your interest, your liability is going up. The liability is going up, but then unless what? It goes up but then you pay, right? You have to pay the lessor. So when you pay the lessor, then your liability reduces. Does everyone understand this? Okay, let's do an example. So I have a lease, right? I said debit asset 10,000. credit liability 10,000, right? That's my initial recognition or initial measurement. Subsequently, what do I do? Said, let's say the asset is over 10 years. So debit depreciation of how much? Depreciation is 1p, okay, of 1,000. Credit accumulated dip 1,000. I'm assuming it's for over 10 years. Because I have this liability here, I must account for what the interest. So let's say my interest rate is maybe what 8%. Interest rate is 8%. So debit interest expense of how much? Is it 800? 800. Credit interest liability of 800. Good. So I've recognized my initial recognition. I've done it. Subsequent recognition for the asset, I've done it by depreciation. Subsequent recognition of the liability, I've done it through what? Interest expense. Now what else? The payment. Now when I pay the less, remember this interest, debit interest expense and credit interest liability is what? It's an accrual. You've accrued. Right? That's why you increase the liability. Now that it's time to make payment, what is the journal entry? To pay to the lessor. What is the journal entry to pay to the lessor? What do I debit? What do I credit? Let's say the agreement says that you pay 2,000 every year. So you say what? You say credits, the easy part first. Credit bank of how much? What did I say? 2,000. I can't even remember. 2,000. And what do you debit? You debit lease liability. How much? Of 2,000. This is it. You've accounted for IFRS 16. Debit asset, credit liability. Because I have an asset, I need to depreciate it. Debit depreciation, credit accumulated depreciation. Because I have a liability, I need to account for the interest expense. Debit interest expense, credit interest liability. I need to pay the lessor. Credit bank, debit, lease liability. I'm reducing my lease liability because what? I've paid. Remember, this payment is interest and capital. Right? Is it difficult? Easy. Easy peasy. Any questions? What is important to me is understanding the principles. Why are we doing this? So that when you go back to read, you understand. Does it? Any questions? Any questions? Is there anything that we discuss? Yes.
Hi, Mr. Gordon.
Yes.
Yes, if I may ask, on the last part, to the amount that you have to pay to the lessor.
Yeah.
The 2,000, is it the is it the 1,000 plus the 800, or is it just an amount that you just came up with?
Yes, it's an amount that, remember, in the agreement, in the lease agreement, the lessor will stipulate how much you need to pay every year for you to be able to settle the loan.
Oh, okay. That's where we get that amount. Okay.
Yeah, that is where we get that amount.
Okay, no, thank you. Understood.
Good. So that is it. So on your balance sheet, you will see that now after the payment, what will be the amount of your liability? Your liability, that is in your balance sheet. So balance sheet where we have non-current liability. What do you think the amount will be for on your balance sheet, the non-current liability? What do you think it will be? the liability for your lease, what will it be? Based on the general entry that we have passed, what will it be on your balance sheet? The final value.
Is it 2,000?
I would say 8,000.
8,000. Whatever you say, I write it, ne? 8,000. 8,000. Oh, is that your final answer?
Oh, that's my final answer. I would say.
Okay.
Yeah. So let's go back and say the one.
So I'm closing the bracket. Because your final answer. Anybody? Non-current liability?
12.8.
12.8 thousand. Okay, so 12,800. Okay, any other answer for the final value of your liability? Your lease liability. Okay, cool. So my lease liability, right? I'm also going to do mine here. My lease liability, what did I start off with? I started off with what? 10,000. 10,000. Then I accrued 800 rand, plus 800. Then I debited it 2,000 minus 2,000. So what do I get? $8,000.
8.8.
8.8. 8.8 will be my lease liability. 8.8 will be my lease liability. So when UNISA asks you to, guys, they give you a scenario, they give you a list and they say, okay, provide an extra to the balance sheet as at 31st December 2021. You look at, okay, current liability. How much did I start off? I started off with a credit of 10,000. I accrued an interest portion which affected my liability of 800 plus 800. Remember, even the general entry will tell you credit liability 10,000, credit interest liability as a result of the interest 800. Now you debit liability, you've reduced the liability by 2,000, so it's 8,800. That's your final value. But this, what is in bracket, you must show the examiner that this is your working. If you don't show the examiner, you get it wrong. The examiner is trying to find marks, but they can't because you didn't show any working. They are trying to, because people are failing, so we are trying to give marks, but we can't find it because there's nothing. At least just even write 10,000 and get it wrong. We know at least you try. We'll give you half a mark or something. So don't leave. So open bracket, write something so that at least we know you did something. Good stuff. Any questions so far?
So hi, Gordon. Please tell us, why did you subtract 2,000?
I subtracted 2,000 because remember the last journal entry, it says debit lease liability credit bank. What were we doing there? We were paying the lessor. When you pay the lessor, you have decreased the lessor's liability, isn't it?
Yes, remember, I understand now. Thank you.
Good. Cool. Remember, we've recognized this liability because you are saying that you are liable to the lessor for 10,000 initially. Now, at the end of the year, you are accrued for an interest expense, which also increased your liability by 800. Then at the end of the year, you settled 8,000 rand out of the liability. You've settled it, so you have reduced the liability. So that's why you subtract 2,000. That's why you subtract 2,000. Okay. Any other question?
Gordon?
Yes.
Can we go back to the Excel? Yeah, there.
Yeah.
So what you are advising us to do is to say for every calculation that you do, you need to show everything in a form of how did you get to your answer?
Yes.
Okay. No, noted. Thank you.
Yes. Especially when you are asked to prepare an income statement and a balance sheet, and you must show the working. Yeah, because sometimes when you show the working elsewhere and you forget to cross-reference, the examiner doesn't know where to look. But here it is easy for him to see. You understand? It's also quicker for you as well. Okay. Any questions? Okay, we've spoken about the exemptions, right? Then we have an example. Must we do this example? You know it already. I don't even. Okay. Let's do it. I think I know why we must do it. I'm giving you 2 minutes. Let's read it. Read this question and digest it and assimilate it. This also from your TAT letter. Okay. The end of the reporting period of P Limited is 31st December. On 1 January 2016, P Limited entered into a lease agreement, right? So in this case, they've told you that it's a lease agreement with our Limited to lease a new office building from our Limited for a non-cancelable period of 10 years. So now we know the lessor is our Limited and the lessee is what? P Limited, because it says P Limited leased the building from our Limited, right? For a non-cancelable period of 10 years, starting on the 1st of January 2016. At the end of the lease term, P Limited has guaranteed our Limited that they will receive a residual value of at least 25 million for the office building. On 1 January 2016, P Limited expects that it will have to make a payment of 2 million under the residual value guaranteed. That is, it's expected that the market value of the office building will be 23 million, and P Limited need to pay the shortfall of the 2 million. P Limited does not have sufficient information to determine the interest rate implicit in the lease. P Limited does not have sufficient information to determine the interest rate implicit in the lease. Therefore, what? They use what? The incremental borrowing rate of P Limited is 12%. So the standard says that if you don't have the information to determine the imputed interest rate, you can use what? The incremental borrowing rate. The borrowing rate that you get from the bank. Good. The following information has been extracted from the lease contract. 1 January 2016 is the commencement date of the lease. Good. Deposit of 500,000 paid on the 15th of December 2015 to secure the lease. There was a deposit of 500,000 paid on 15th December to secure the lease. Who paid this deposit? Okay. P Limited incurred legal fees of 20,000 relating to this lease contract. Our Limited partially reimbursed P Limited and paid 10,000 over to P Limited on 1 January 2016. So as you are reading the question, your mind, because you know if it's 16, your mind is telling you, so what is this? What is this? What is this? Why are they telling me this? What is this? So that point number 3 saying P Limited incur legal fees of 20,000. These are legal fees. What are legal fees according to the standard? They should be included as part of the asset. But you must exclude what? Reimbursement or So our Limited partially reimbursed P Limited 10,000 over to P Limited on 1 January. Good. Annual lease payments payable in arrears are 2.5 million. So they've given you what? The lease payment on a yearly basis, 2.5 million. So you have, okay, cool. So that's the information you have. You know the present date, 1 January 2016. That's the date of commencement. You know the annual lease payment to be 2,500, payable in arrears, payable at the end of every year. Sometimes UNISA can say payable in advance. I'll show you. When we say payable in advance, you put your calculator into the beginning mode. So the calculator, your financial calculator has got normal mode, which is assumed that it's at arrears, So the normal mode is at arrears. But when you put your computer at the beginning mode, when UNISA tells you that the lease payment are paid in advance, that means you pay it before you use it. You paid on the 1st of January, you use it for the 1st of January 2024, you use it for the whole 2024. You paid in 1st January 2025, use for the whole 2025 year. Okay, good stuff. Cool. Annual lease payment payable in arrears is that. Okay. So I think the question is that prepare the journal entries. Prepare the journal entries to account for the lease. Prepare the journal entries to account for the lease. Good. So P Limited should initially recognize the lease liability at the present value. So for a lease, you start off by what? Calculating the lease liability first. Why? Because your asset, the starting point of your asset is the lease liability. So you first have to calculate the lease liability first. So P Limited should initially recognize the lease liability at the present value of the unpaid lease payment, using the incremental borrowing rate of 12%, which is that. So your future value is 2 million. Your N is 10. Your payment is 2,500. You see, in this case, because the payment is 2,500 every single year, you don't have to do with that cash flow. The cash flow, you only do the cash flow when the payments are irregular. 70,000, 60,000, 50,000, 10,000, then that is the cash flow mode. But here, in this case, it's not a cash flow mode. So you can put all of them as what? As your payment, PMT. So future value is 2 million. Your N is 10 because it's for a period of 10 years. The lease is for a period of 10 years. Your payment, so you say 2.5 million PMT. Because you have said 2.5 million PMT and you have said N is 10, the calculator knows that you are paying 2.5 million rand every month, every year for the next 10 years. The calculator knows that because you have said N is 10 and my payment is 2.5 million. So the calculator will calculate it based on what? The fact that the period of the lease or the agreement is 10 years and you are going to be paying regular same amount of 2.5 million every year. Your I is 12%. You compute present value to give you 14,769,504. You can try it on your calculators. You get that answer. Hey, but let me see something. How did they get a future value of 2 million? Let me see. P Limited expected to have to make a payment of 2 million under the residual value. Okay, all right. This one is a hard one. Okay, so whenever you are calculating this present value or you do it from the perspective of the lessee, right? The lessee. You do it from the perspective of the lessee. The lessee. But let me see.
Gordon.
Yes.
Just to ask about that future value, because there they said they will receive a residual value of at least 25 million.
Yeah.
But 2016, we expect that it will have to make a payment of 2 million. So yeah. How? Because I see there's also another 23 million.
Okay, let me read it. Let me read it. At the end of the lease term, P Limited has guaranteed R Limited that they will receive a residual value of at least 25 million for the office building. Okay. On 1 January 2016, P Limited expects that it will have to make a payment of 2 million under the residual value guarantee. That is, it expects that the market value of the office building will be 23 million. And P Limited needs to pay the shortfall of 2 million. P Limited does not have sufficient information. Is the following: the budget of 500 P Limited in killer bit of trade. Okay. Yeah, the value of 2 million. At the end of the reporting period, P Limited is there on 1 January 2016. P entered into it. I'm coming. I'll show you now. Okay. All right. Remember. Okay. So this question is saying that, right? P is saying that at the end of the lease term, P Limited has guaranteed R Limited that they will receive a residual value. That is, so it's just saying that at the end of the lease term, the value of this building is going to be what? It's going to be 25 million. Then on 1 January 2016, P Limited expected to have to make a payment of 2 million under the residual value guaranteed. That is, it expects that the market value of the office building will be 23 million. So this 23 million is just, they are just saying that at the end of the 10 years, the market value of the property is going to be 23 million. It doesn't say that it's not telling us that anybody, whether P or R, is going to be paying 23 million or 25 million. The only payment that is going to be made, as far as the residual value is concerned, is the 2 million. The 25 million and the 20 million is just telling you what the value of the building is going to be at the end of the 10 years. But it's not telling you that someone has to pay that value. It's just telling you that the market value at the end of the 10 years is going to be 25. So initially they said it was 25 million. Then later on it decided that okay, it's going to be 23 million. Therefore, P Limited has to guarantee that it's going to pay 2 million. So because of that guaranteed residual value that is going to be paid, you need to take that into account in what? In calculating your present value. In calculating for your present value. So that 23 million and 25 million is just the value of the property at the end of the 10 years. No one is going to be. It's just like someone give you an information that, you know, at the end of the 10 years, this property is going to be 25 million or 23 million. But the standard specifically states that the amount of the residual value that you are going to be paid must be taken into account in calculating what? For your present value.
Okay, just to ask, let's say, I don't know if it is possible, they don't give you that payment, or they don't mention the expected payment, like, or a guarantee. Let's call it a guarantee that we should be paid. They just mention the way, say that the residual value will be this amount and the market value like that. So how do we work on that? Or it's not possible? They will always tell us there will be a payment.
Yes, they always tell you. If they want you to take the payment, the residual payment into account, they always tell you that this amount will be paid. But if they are just giving you an information to say that at the end of the 10 years, the value of the property is going to be 23 million, 25 million, that is, it's nothing. You can't, it's just information. It's just information. It doesn't. You see, if you look at the formula, everything that you put here is what are things that you are going to be paying. Things you are going to be paying. Future value of 2 million. The lessee is going to be paying that, right? The payment of 2.5 million. The lessee is going to be paying that every year in arrears, right? The 23 and 25 is just information telling you what the value is going to be
of the asset. Okay.
So in a question, why would UNISA do that to you? The only way UNISA would do that is maybe if unless maybe you are accounting for the lease on the as an investment property and it's on the fair value model, and then therefore you can say that okay, I must use I must account for the fair value. Other than that, no, you won't need it. You won't need it. Any other question? Hey, are we done? Okay, cool. So the general entry, right of use of an asset, you debit it, right? 15,265,504. Lease liability. So the first part is the lease liability, which you calculated here, right? The 14,769,504. Guys, use your financial calculators and try and get this amount of 40 million. You get it. 14,769,504. So you have right of use of an asset, credit lease liability 14,769,504. But when it comes to the asset, remember when it comes to the asset, so the liability part we know is 14,769,504. 69504, right? When it comes to the asset, remember, it is the liability plus other things, right? Plus the initial direct cost, plus the restoration cost, the present value of the restoration cost, if it is plus other initial costs. So let's see how they go. Okay, so remember, they also had a lease deposit, a debtor of 500,000, and this is what increased the value of the right of use of asset. So the right of use of the asset, it starts off with what? 14,769,504. Then we add any other payments, right? Legal fees, deposit, yada yada yada, all those things. We can call it a day.